Bond market, right? That's what determines interest rates, right? Everyone like nod if you're like, I got this, because obviously all supply and demand, right? So if you think about it, all the dollars that are invested in the world, mine, yours, big pension funds, they're usually in bonds or stocks. And the more, usually with good economic times, the stock market's going up, so more people buy bonds, less stocks, less people buy bonds. They don't want that safe return. They want the John, you can't correct me if I say anything wrong. So most people during good economic times invest in stocks. No one really cares about bonds because you get a lower return. But then when things get, when you have like wars going on, economic uncertainty, things like that, then more dollars, right? People will start to say, okay, well, I don't want to invest in the stock market anymore because it's going to go down, it's erratic, so I'm going to invest in the bond market, which is a more stable return. So as those dollars flow out of the stock market into the bond market, what happens to bond prices? They go up, right? Supply and demand. And so that means lower mortgage rates. Right. So a really good rule of thumb, good economic times, higher rates, possibly. Bad economic times, lower rates. But there's a cycle that it goes through. So I talked to Jay a couple days ago, and he was like surprised that the bond market was repricing. He was going to lock someone in, and then like the pricing got worse. And so do you guys have the Rate Watch app? Because if you have Mortgage Coach, you have the Rate Watch app as part of that. Okay, so here's what it looks like. I don't know how to do screen sharing or anything cool like that. So it looks like this. If you look it up, it just looks like you have it, I'm sure.
Right, yeah.
Top left there. Okay.
You teach us how to read it?
Yeah. That's,
what does it mean?
Yeah.
I get this outdated in my
Yeah, so these are called Japanese candlesticks, right? So people that are like stock traders, maybe you're into that. I'm not into that. I just look at it when I have to. But in general, this is the price of bonds here, and this is tracking mortgage bonds. This is the price of bonds, and this is the date. So the higher the price of bonds, the lower the interest rate, right? And so it's very easy, with this app, you can share screenshots, you can do fancy reels with it, or whatever you're into. You can copy it and paste it into an email, and you can show people. There's some parameters up here, so if you want to, go back and do this over like a 10-day period or a 30-day period or a year or whatever, you can show the trend. And so it's very easy, this is a 30-day period, to explain to someone once they know that basic relationship, that the higher the price of bonds, the lower the interest rates, and vice versa, that bond prices have fallen off a cliff, right? So, and even from Friday to Monday, right? We had that freaking inflation report that, so, or Monday to Tuesday, I should say. So big drop off, and it's like, rates are worse. Just Google it. It's not, you can always support what you're telling them when it's bad news with charts, headlines, things like that. So this is free, so you should use this. Some of us subscribe to a thing called MBS Highway, which sends out a daily email with like people talking about what's going on. It's like $1,200 a year, so I wouldn't sign up for it at this point unless you really want to. Especially because if there's someone in the office here that has it, you can just watch the video together, right? This you can set up alerts. So if the pricing changes, right, where typically they'll say, if the market right now is up 19 basis points, so that's good. If it was down 20 basis points, what does that mean? That means that yesterday you quoted a rate with no points, and today you got to charge 0.2 discount points, roughly, to get the same rate. Okay, and so when you look at, these prices were like, August 4th, they were like at 102.3, and then today they're at let's call it 100, so you lost 230 basis points, right? So 100 basis points is one discount point you have to charge in fees. So 230, you know, you're talking about maybe almost 0.75% in interest rate, you know, 0.5% to 0.75% in interest rate. It's a big movement in a 30-day period. So this, I mean, that's what I do to read it, right? You look at it, the red means, you know, it shows you a range, like the top of the candlestick, the bottom, that's just the range the bonds traded in that day. You know, big red candlesticks suck. If it's red, it means it closed at the bottom of the range. If it's green, it means maybe it moved back higher at the end of the day. And so that's, you know, that's kind of the extent of, you know, when I'm quoting a rate and I'm like, this is gonna suck compared to like what I showed you 3 days ago. Like, I'm always including a screenshot of this, draw a little line, like, yeah, here's what it means. No more than 2 or 3 sentences. Like, don't be a Ryan Erbach, who's a loan officer that used to work here. That was just funny, but like, poor guy, like, never closed more than 30 loans, and he was 20 years in the business. And he would just confuse the hell out of his clients. Like, we have offices next to each other, and I'd come in, he'd be doing a buyer presentation. He's like first-time home buyers, you know, with like a 420 sweatshirt on or something, and he's like, and then there's resistance here, and then the technical rollover, and these people are just like, can we get the loan? Like, what, you know, so you don't want to like bore the heck out of people. You just want to have enough data, 2 or 3 sentences, right, that they know you know what you're talking about, but like, you're not teaching them how to day trade using candlestick charts, right? So yeah, MBS Highway. If there isn't anyone here, I get it. So we can just do a quick Zoom, and it's like 7-8 minute video every day, and we can watch it together. Questions on anything so far? Okay. So
Actually,
why?
what is the MBA, like, what does it tell you? What's the daily kind of takeaway from it?
Yeah, so usually I mean, we can watch one.
It's the single most impact that like I've had on market knowledge.
Is that how you get your content for your videos?
Most, yeah. Yeah.
Yeah, I
But
mean,
do
they
you
talk
pay
about.
the premium one to get the content?
Well, it's not this, so this is free, Rate Watch, if you
Watch,
get Mortgage
yeah.
Coach, you get that, and
Yeah.
you use the same credentials, they'll log in. And I was looking at it this morning, cause I haven't in a while. I mean, it tells you a lot of cool stuff, like it tells you, again, you can set alerts, so I got sidetracked, right? So you can set alerts like, hey, 8 times out of the day, or every 3 hours, whatever, I want a text alert of what the market is doing. You also get alerts if the market is starting to move negatively or improve. We haven't seen that in a while, but where maybe, right, if it's starting to improve a lot, you're like, oh, I'm gonna lock you a little later in the day, right? Because I'm probably gonna get better pricing. Just know banks are really slow to improve rates when the market is improving. They're very slow to do it. You might have to wait till the next day, but if the market's getting worse, you have like 5 minutes before Optimal Blue's like, you know, expired. You can't lock. And then when they come back on, it's gonna be worse pricing. Okay, so you wanna keep an eye on it. If you have someone under contract, that you're gonna have that lock conversation, you know, today. So you can get these text alerts if it starts moving, maybe 15 basis points worse, or more. Maybe you'll get that alert and you know, like, okay, stop this and get this locked in, right? This is higher priority now. So that's why you need this. Emily, I would say we just watch a video, but it just came out. Should we watch it?
Yeah, I haven't watched it this morning, so kind of nice.
So they talk about economic reports that came out and their advice, you know, if you should lock or float, and they're not always right, but you know, this guy Barry Habib that runs it wins like the prognosticator of the year Google award, like every last 2 or 3 years, for just being able to predict the market. So he's a smart dude.
It was pretty cool. They did what they were gonna forecast for 2021. Is that what they did? And then They went back onto that forecast and they
Oh,
were
yeah.
like pretty damn spot on. It was impressive to
Yeah.
watch.
So, I don't know the best way to watch it outside of just doing it on my phone.
Do you can you go on Chrome real quick? I'm sure I could probably remember my login.
Oh yeah, let's do that. So again, why you need these alerts and this knowledge? The alerts, of course, if the market's moving worse, so you don't get caught with your pants down. You know, working on a reel like me for like 45 minutes and then like, oh shit, I forgot the lock. Also though, this knowledge is just helpful because as the economy, you know, as we head into this cycle, you know, we don't know how bad it's gonna be, and like, they say like 80%, this isn't working, 80% of, you know, realtors that are out there right now were not in the business in 2008 and 9, so they don't know this market, so they're gonna need reassurances, data to help them deal with the questions they're facing, which are the same questions you're gonna be facing from clients. So you can be that source of knowledge, and then you end up, you know, strengthening that relationship. I would recommend, you know, I use this Market Watch, so it's just a bookmark, so an economic calendar, right? So that you know what economic news is coming out, you know, in the next few days. Like, usually the economic news that affects mortgage rates the most are anything inflation related. So that's the CPI, came out yesterday. PPI, which is producer price index, so that's like the index of the cost that a producer, a company pays for their hard materials before they produce a product. The CPI is consumer price index, so it's like a basket of goods at the grocery store and gasoline or whatever, an average rent, how much is it this month compared to last month? And so, yeah, so just bookmark something like this so you can see what those things that are coming out. So again, you're not caught if someone comes under contract at 3 o'clock in the afternoon. You may and tomorrow's a jobs report. You may decide that you want to lock them in, or at least let them know, like, hey, we have 2 hours to do this now, or we're subject to whatever comes out in the jobs report tomorrow morning, because it comes out at 6:30, way before rates. So anything with inflation, CPI, PPI, and then the consumer price index is another one, and then the jobs report, which comes out the first Friday of every month. So those are like usually, I think, the biggest market moving type economic reports. Would you agree, John?
And one thing I'd add is know your audience. So like, if you are sending a screenshot where you don't have this source linked, that's sometimes better than sending like a link where they can like keep looking at it every day after you lock them.
Yeah.
And then they're like, well, this keeps getting better. Why?
Yeah.
You told me it's bad and now it keeps getting better every day. I want a better rate. So like, you know, if it's a sophisticated customer, you may want to stick with more like anecdotal, like this. This doesn't say what the market's doing, it says what the market may do based on this information.
Yeah.
But yeah, like if you're sending something that's gonna really show what the rates are doing every day and you lock them and they're like, well, the rates keep getting better, I want a better rate, you know? So.
Yeah, so it depends. I mean, I'll send them the screenshot, and luckily it just keeps getting worse. But you know, I've certainly had
Right now, yeah.
so many situations where people that locked like 2 weeks ago are like, "Hey, I heard it's better," and then first place I look is there, and usually with just the screenshot, you're like, "Actually, no, it got better like a week ago, but it wasn't better enough to renegotiate the rate." And today, as you can see with this little line I'm drawing, it's the same thing, and then they're done.
The thing that you have up there, reprice lock alerts, you have an alert for that?
Yes, so both the Rate Watch app, I think you can set up alerts to send you texts.
Sorry, I was
Rate
thinking
Watch.
like renegotiation, just.
Yeah, and then the mortgage, MBS Highway does it too. So, let's see, I'll give this one more try. Oh, there we go. So is it just MBS Highway?
Probably.
Like everything is so auto-populating on my computer, I don't remember. Well, this is a little delayed.
mess up there. Watch out.
New Jersey. So yeah, like John said, know your audience and,
Oh, really? Yeah, I mean, if you.
get an
start
idea of
following
how
people on
much,
social
you know,
media,
how much
start to
detail you
track
feel like you need to provide.
all these mortgage companies do all these events, like whenever he does the like the morning thing, so half the time he's my hotel rooms, cause it just speaks up all over the place, that's crazy.
Which,
Try our pedigree.
don't write it down, cause if you guys log on, it boots
can't
you
log
out.
in.
This is
Yeah,
what-
I shared with Chris for a while, and I'm like, I used to listen to it on the way to work, and all of a sudden it would cut out, and I'm like,
Yeah.
I'm like, Chris, get your own. Try our pedigree.
So the password you have for like
Everything.
everything?
Is it? Oh, I know that one. He's like, oh,
I know that one.
We already know it. What is it, Ryan? Just kidding.
So you,
Password for middle
y'all
school.
should be on Surefire, right? We already pay for this thing you're getting every day. You guys get this every day?
I don't get it.
I don't get that.
I don't get it.
No, but we,
This
I
one?
do have Surefire, but.
Is it supposed to be emailed to us automatically?
Yeah, you have
Yeah.
to, I can't remember, wasn't getting it for a while, I don't remember how you have to.
I'll send y'all the link again on this. So this is one of the kind of digests, and then
It's just like a daily
the
comments.
MBS, yeah. So these two we already pay for, Surefire, and then MBS Highway, and it's interesting to read both of them every day, cause the advice is sometimes conflicts with each other, so you sort of know, like, if the advice on both of those is different, like, this is gonna be a messed up day. Cause nobody knows what the hell's going on.
It's in updates, G.
Sorry? Yeah. So I was just gonna show really quickly. So this is just what it looks like. Very similar. It's got more stuff, but I never look at really anything else on here. So yeah. And you can go back. Jeez Louise.
Did they forget to get this one updated when they updated all the sit rooms?
Probably, I keep complaining about this system.
Let's go back 2 years yet. Okay, there we go. So this is kind of a one click down. There we go. Okay. This is a good screenshot that I think Chris Hauber sent out too, that he used to send it on the bottom of his lock email. And I do that too, because it really shows, you know, if we go back 2020, 2021, you know, I always tell people, look how boring it was. Rates were just hanging out in the 2s and 3s and really no volatility, no movement. Like, I mean, last year was so boring, it was great. We never had to like quote a higher rate than earlier in the year. And then, as you know, I'll get into last fall, it really started, bond prices started to move lower. And that's because the Fed, you know, was buying a lot of bonds. I'll get into that, but you know, basically I just show them it's been such a drastic move that, you know, because we offer the free refinance for repeat clients, you know, even if rates drop by 0.5%, we can do a free refinance for you to save yourself based on their loan, you know, $200-300. You'll probably say yes, right? So this is how maybe you can advise someone to not pay points when you're looking at the TCA together, because if it takes you 5 years to break even on the points and you're gonna get rid of the loan in a year, maybe 2, it's wasted money. But at the end of the day, you can lose a loan by giving too much advice like that too. Like if they want the lowest rate and they're okay paying 2 points, great. Show all of them, you want that one? No problem, locked. Right, I gave you my advice, and at the end of the day, they probably could care less, you know, if they lose a few $1,000s in fees. Okay, some people also don't believe that rates are gonna move lower, and like they're not gonna change their mind. And it's like, okay, yeah, we can get you a lower rate. You want the Quicken quote, you know, the Rocket Mortgage quote with 2 points? No problem. And so we show them that. So, bear with me here. instead of my office, my old eyes.
Yesterday's CPI report was a gut punch to mortgage bonds. Today's PPI number? Let's talk about it and let's
Where is
see
it?
how long will bonds slide.
Oh yeah, it's way delayed, so. Why don't we watch this like on one of our computers? We can all huddle up.
Yeah.
After,
Probably better, yeah.
it's also 12 minutes long, which means it's gonna take a half hour on this computer.
At least.
All right, so, I'm going through the stuff that in pretty much every conversation we're covering, right? Especially with realtors, because they have no idea how economic cycles work. And you can have all these pictures, all these graphs. You can take as much or as little. Again, maybe you're a first-time homebuyer that's doing CHFA and they only have one rate and one option. Like, you probably don't have to get into so much, but you can still give them a glimmer of hope that rates are gonna come down, and then probably in the next couple of years, and you're gonna be able to get them a better loan, and reduce the payment. Inflation and mortgage rates. So inflation is the arch enemy of mortgage rates. It's like the worst thing that could possibly happen, because if you think about it, if I owned your mortgage, right, and your principal and interest payment to me is $2,000, the more inflation, I know I'm getting $2,000 for the next 30 years every month. The more inflation there is in the economy, the less that $2,000 is gonna buy me, right? And so when we have times of high inflation, banks, people don't wanna buy a bond that's paying them $2,000. They wanna buy a bond with a higher interest rate. They want a higher return on their money, right? So banks can't sell mortgage bonds today at 3%. No one wants to buy that. They're gonna sell mortgage bonds at 6%, because that's kind of, near the rate of inflation. And there's buyers at that level. They're like, yeah, I'll take $3,500, return, not 2,000. Okay, so the only way they can sell bonds, they can get buyers, is to offer higher interest rates on mortgages. Because that's the only bond that someone will buy. Okay, so because inflation is the arch enemy, what we see on this chart is that when we look at the consumer price index that came out yesterday, and then we look at the average 30-year fixed rate, we can see that as inflation moves higher, mortgage rates move higher. As inflation moves lower, mortgage rates move lower, right? They really follow in step. They didn't in this period here, so during COVID. And they didn't because the Federal Reserve was buying like $100 billion plus of mortgage bonds. So they were buying like 60% of the market, right? So they were buying the market, which kept prices super high, artificially high. So even as inflation started to come back last year in 2021 and started to move up very sharply, the Fed was still buying mortgage bonds. And that kept rates artificially low. Okay, so you'll hear things that, they waited too long, right? And then they started selling them, and then as soon as they stopped buying them in January, as we saw with that bond market chart, mortgage rates moved right up with inflation, right? Follow the same path. Inflation drops here, mortgage rates drop here, then up, then down. So it really follows it very, very in line. So and the reason why is because there's nothing more important to someone who's gonna buy a mortgage bond than inflation, because of that return over time, right? So what the Fed is doing now with all the rate hikes is, the Fed only has two tools that they can use to try and help the economy. They can either cut rates or raise rates. And so by doing these rate hikes, they're increasing what's called the Fed funds rate. The Fed funds rate plus 3, that's the rate that banks use to lend money to each other. That plus 3% is the prime rate, which is what your home equity lines are based off of, car loans, credit cards, things like that. So if you have a home equity line or a credit card, your next monthly, if the Fed raises 3/4 of a point, next month your rate goes up 3/4 of a point. Okay, so it follows it exactly. as the Fed raises rates and it makes all these things, home equity lines, credit cards, car loans, more expensive, then what's gonna happen to the demand for goods, right? It's gonna move lower because people are like, oh, I don't have as much money at the end of the month as I used to, so we're not going out to dinner one extra time, right? And so those, or they're not gonna go buy as many things, which is gonna help bring down inflation over time, but it takes time. And so that's what the Fed is doing. They can only lower rates or raise rates, and raising them is how you slow down the economy and cool down inflation. So that's one of the hardest things to explain to a buyer or a realtor, because like, no, they're raising rates. They're raising rates tomorrow. And it's like, yeah, it doesn't mean mortgage rates are gonna be 0.75% higher tomorrow. And so you have to be able to explain that relationship in a way that is short, right, and concise, unless people really wanna talk about it in more detail. So as rates move higher, inflation will move lower, and that's what we're all hanging our hats on right now, right? That we're hoping that's gonna happen soon. This was just an article that I found, and the headline was, "Want a guaranteed recession? Start raising interest rates." So when the Fed raises rates, throughout history, these gray areas, shaded areas, are recessions. So basically you have a period of rate hikes, then there's a recession. You have a period of rate hikes, then there's a recession. Rate hikes, recession, and so on. And so that's what we are all assuming. The best that we can do is look at history, that's what's gonna happen here, probably in the next year. Questions on any of this? Make sense? Okay. This is a similar chart that goes back even further, that just shows, as rates move higher, there's a recession right after, and so on. So, Fed rate hikes cause a recession. Now, what happens to mortgage rates during a recession, right? So this is another chart that you can use, and each one of these could be like a cool video that you can do. Ryan's done some and everything, and if you're doing realtor presentations, like, you had a great feedback from like your #1 team, because they have no idea, and this at least gives them an idea of some things to talk about with their clients. So, during this recession, the rates went from 16 to 12, 18 to 13, 11 to 8. So during recessions, historically, interest rates move lower. So Fed is raising rates to calm down inflation. That will likely cause a recession, and the recession will bring on lower mortgage rates down the road. So it's kind of a little bit counterintuitive.
This is also a good chart when you're talking about buying down your points, because right now we're talking about don't buy down points because rates are gonna come back down, but if someone's on the other side of that argument, you're like, okay, well, actually, in the history of mortgage rates, like, we're still at one of the lowest points in mortgages.
Yes.
And we think it's high because we've been thinking about things for 2 years, but it's actually still in a historic low pattern. So there is an argument that rates may not see where we were for the past couple of years ever again, or a long time.
I mean, I always tell people, like, we probably won't see 2s and probably not 3s again, right? Hopefully one pandemic per lifetime, right? Like, that's good enough for me, we agree. But, when you see, like, why would someone pay points here, when like a year later they went from, you pay a point to go from 11 to 10.5 maybe, or 10 3/4, when a year later or 2 years later you're in the 8s, right? So yeah, you can, all you can do is present the data, and then the clients are gonna make their own decision based on that. I feel like clients wanna be led, they want someone and realtors, they want someone with an opinion. So you gotta make that opinion, but, you don't wanna paint yourself in a corner that, yeah, totally wait. You have to wait to lock until tomorrow. Because even Barry Habib's website said, hey, this inflation report on Tuesday is probably gonna come in lower based on all the projected numbers, and it came in higher, and look what happened. It lost like 70 basis points or whatever it was. So this is a good one. You can use this yeah, any of these historical rate charts, when you have your first time buyers that are like, oh, I'm just gonna wait for them to get back to 2.5 again, I'm like, I don't think that's gonna happen, so, yeah. All right, so the other question that, right, the realtors are dealing with, we're dealing with, right, is like the fear of like what happens during home prices during a recession, because these realtors keep posting shit on social media like, look how many price reductions there were today, yay, it's like you're shooting yourself in the foot. Like, that's not helping, you know, because people, when they hear recession, think automatically 2008, right? That was this recession, which was pretty much the only time in history that mortgage rates, besides for the Great Depression, that values dropped significantly during a recession. Okay, but it was a totally different market. That's like a whole hour conversation, you know, and if you guys want me to go there, I can, but basically you can show them that this is the Case-Shiller Home Price Index, right? So every recession, these shaded areas, home prices remain stable and continue to move upwards, okay? So there's no, like, if there's gonna be a recession and I'm gonna get this $500,000 house for like 400 next year, like that's likely not going to happen. 2008, the reason why it was different, like no one had any equity, right? You guys want to talk about this for a second? Compared to now. So, you know, 2005, 6, 7, 8, I mean, everybody that came in wanted to do 100% financing. It was all done with an 80% first mortgage and a second mortgage for 20%. That started off in 2004, 5, like you had to have a 720 credit score, W-2, money in the bank, even though you're not putting it down, like 6 months reserves, something like that. That devolved, you know, by 2007 and 8 to like hedge funds that were just like, no, let's make this available for everyone. So you could be subprime, like, which means below 620 credit score, can't do a normal conventional loan. You could be one day out of bankruptcy, go finance 10 investment properties with no money down, no income verification, no assets, no employment verification. So, and everyone was cash flow negative when they did that, and they're just like betting on appreciation. So then what happens to, if you think of the whole US as like one neighborhood, right? Or one condo complex. One of your neighbors that just did 100% financing gets relocated to a different state, they have to sell, but they can't sell because they gotta pay the realtor 6%, and the home is worth what they paid for it. They have no equity. So then they have to do a short sale and negotiate with the bank to sell the house and pay off the loan for less than what they owed. Now that's a closed sale. So that just starts this vicious cycle, right, of foreclosures, because if people couldn't sell, they couldn't get a short sale done, then, you know, they still have to move, and they're like, well, I didn't put any money down, so I don't really care. So you can have the house back, Mr. Banker, and that initiates the foreclosure. The bank's gonna get rid of the house as soon as they can, so they're gonna reduce the price, and now all of a sudden you have declining values. Okay, so that happened because of the horrible loans that were being done back then, and the fact that no one had any equity. Compare that to now, we're starting to see, I'm getting spam emails for like stated income stuff.
Are you?
Yeah.
Really?
No asset verification.
No way.
Again, but what's the average loan to value in the United States? And depending where you read it, it's somewhere like 50 or 60. So most people have hundreds of thousands of dollars of equity in their house. So if you foreclose and give the house back to the bank, who gets all the equity?
It's the
The
bank.
bank. Yeah, so like who would ever do that, right? I mean, if you're like the worst case scenario, you lose your job, you run out of savings, you have no family help, you can't do forbearance anymore, then you're gonna sell the house. You're gonna call your realtor and sell the house, pocket $200,000, go rent someplace and figure out the next chapter of your life, right? You're not gonna just be like, okay, never mind. So the likelihood of a wave of foreclosures or short sales, like who would have to do a short sale? Like you have a lot of equity, you can sell the home for more than what you owe. So those were the reasons why prices dropped significantly. Okay, so now the other question that comes up is, well, I'm seeing all these price reductions. Thank you, friendly realtors trying to somehow get business by telling everyone the market's crashing. So, so, you know, the price reductions are just because the way I've been explaining it, John, give me your input, or anyone give me your input, but the way I've been explaining it to people, because it's kind of a complex thing, is that, you know, you take the last 2 years, that wild appreciation frenzy of people trying to buy houses, right? You had a $500,000 house in 2020 that sold for $550, right? And then the neighbor lists for $550 and it sells for $580. And then the neighbor lists for $580 and then it sells, if it was this spring, sells for $680, right? And then now the one that's late to the party is like, yeah, I'm gonna list it for $700. And it's like, nope, the market has totally shifted. No one's gonna pay you $700. So now they're like trying to find where the buyers are, right? So they're like, okay, not $700, how about $680? Okay, not $680, how about $650? And like, you know, they might end up in the high 500s, but the people that were buying previously, they were covering appraisal gaps, you know, so like the home maybe was never really worth that high of a price. So that's how I explain it. I don't see prices falling, but again, I just keep going back to this is such an amazing time to buy, because if you know, I just did a video where, you know, even someone when we were using CHAFA to do appraisal gap strategies, right? Let's say someone had 3% to put down, but they had to cover this $20,000 appraisal gap. You can use CHAFA down payment assistance, and at the end of the day, they could be out of pocket about $20,000, and they could go buy a house and compete in the market, the market of yesteryear, which was 2 months ago, 3 months ago, right? Now that same buyer doesn't have to bid up the price of the home, right? And the seller can pay their closing costs. So they go from having to need $20,000 and maybe having to bid up the price $20,000 or $30,000, which means owing $20,000 or $30,000 more at the end of the day, to maybe getting a better price and having the seller pay closing costs so they can buy for like $1,000, $2,000 out of pocket. I tell people that right now it's so important just to get the best terms on the house and the loan that you can get, right? That means how much you owe, because the people that bought in the spring and owe $20,000 or $30,000 more because they had to bid up the price just to be considered, they're gonna owe that money, right? Now you don't owe that money. You have almost no competition out there. The sellers are gonna pay your closing cost. And if we go into a recession and rates drop, the competition will pick up again. Maybe not as frenzied, because some people are gonna be affected by the recession. Maybe they're unstable with their employment, things like that, but it's still gonna pick up. Right now, it's just like this weird, you know, period where everyone's just trying to figure out what the heck's going on. So it's I think a golden opportunity for buyers, you know, low down payment buyers to be able to get in and get something locked in.
So, and just to point out, this is a national index, and if you look right here, where it started going up a lot, what is that, like 2000, 2005, climbing, and then dropped 2008 for the recession. Right there, these mortgages, have you all watched
Big Short?
Big Short? I hope so. That really was very coastal. It was a lot of Florida, a lot of California, which really kind of drug down the market a lot. In Denver's a different market. Denver actually didn't even start appreciating too much. So this is actually, I can't put it up on the screen right now, but this is actually the price index for Denver.
Nice.
And if
Like
you
to see
look,
that.
the crest right here was
It's a lot more flat.
a lot more flat. So the high point right here was about 2006. That spot right here.
Yeah, that's when we bought our first house.
And it went up drastically before it came back down. 2006 in Denver was still coming out of a big recession itself in the 2000s. So 6, 7, not really a lot of change. Crash, 2008, so we're about 131. Into the recession, we're 123, so less than a 10% drop in Denver. And then by 2012, it recovered its price and just went up from there. So that's here. following the market here, 2012, and then it's gone up from there.
Yeah.
So to
Will you
argue
send
like,
that picture out?
yeah, so to argue like, we're gonna wait for home prices in Denver to crash is probably not, you can show them this and say like, yeah, like, you know, it's not the same, it's not a national market, it's not that market.
Yeah.
It's not California, it's not Florida.
Yeah, we bought a house in 2006, our first home that, you know, was in Highlands Ranch, which is a desirable area, and we sold it in 2010 for like $5,000 more than what we paid for it. So there's no drop in prices, and there also was no appreciation.
Mhm.
So that's kind of a more likely scenario where you just run into a time where there's less appreciation or no appreciation for a while. But it kind of works out, cause then we bought our next home in 2010, and it was a, you know, more expensive price point, so I think we paid like $30,000 less than what the sellers bought it for, cause they bought it in 2006. And so, and they were getting a divorce, so I mean, they had to sell it quickly, so we just kind of lucked out there.
But you were 2006 and you bought it in 2010, so
Yeah.
that tracks this, right? So like the index is like 139, that's, 2006 was what the high point up until, you know, 2013, and then you bought it in 2010, so
Yeah.
like, that math tracks perfectly.
Yeah, so, I mean, the places that we saw big price drops were new construction, you know, and that's why, that's, you know, one of the things why I don't really, not a huge fan of new construction. Sorry, Amy, I know she just bought a new construction home, but, cause you're always paying top dollar for everything, right? Like, you want air conditioning, oh, it's $15,000 when you can pay $7,000 if you do it on your own after. And everything gets rolled into the price and the loan. So it makes it easy from a cash flow standpoint, but you end up paying more. And again, part of that Green Valley Ranch, you know, that area out by the airport, that was like, on USA Today, at some point in 2008, it was like front page, foreclosure town USA. That's what it was called, and that's because pretty much, you know, that catered to maybe blue collar type workers. It was all the 5 years before that, as they were buying, was all the stated income loans, no money down, subprime loans, you know, those were all like typically 2-year adjustables. So the rate was fixed for 2 years and had a 3-year prepayment penalty. So you had to take that at first adjustment. And
Or
so-
they were fixed for 2 years, but you had a negative AM for that
Yeah.
entire time, so when it adjusted, you not only paid the higher rate, but you started having to pay your amortization as well.
Yeah, and no one could afford those payments, so, so yeah, that's how I kind of use, you know, this data to help show buyers why, and realtors, like, there's not gonna be a crash. You know, what will likely happen is the competition will pick up again, and you'll have to compete, which means maybe you have to bid up the price, and now you can get it for less, so. Get that now locked in, we'll take care of the loan when rates improve.
What do you think about, like, if someone buys a house now, if we do go into like a recession or there is like a little dip of an appreciation, like how are you gonna coach them through that? Like, they're gonna be like, so I bought this house and it's not appreciating, or it's appreciating less, like, you know, just go like the long-term perspective on that, or,
Yeah,
how are
I
you
mean,
gonna live in this house, like 5 years? Like, I don't know.
Well, you can still show them like a cost of waiting, because it is the same thing, like even in like 2 years, if you're paying rent for 2 years, rents are actually higher right now than they were 2 years ago. So you still have an asset, you're still paying down your loan, even if your value doesn't go up in the same way that it was for the past 2 years, you're still building equity, you're still, you know.
cause you're paying down your loan.
You're paying down your
Right, so
loan.
instead of just. On Mortgage Coach, you know, I always show people 4% appreciation, right? I wouldn't be any more aggressive than that. That's the historical average in Colorado, so that's your foundation for that. And that's it, and then, as everybody knows, you know, it's been higher lately, but, even with 4% appreciation, you can show someone who's buying, you know, a house with a CHAFA down payment assistance loan, you go 4 or 5 years out, not 30 years, just 5 years, 4% appreciation. Now they're gonna have $70, $80, $90,000 of equity in the home, and then show them, okay, now you're gonna sell it up, you're gonna sell the home, you're gonna take part of that equity, pay off the second mortgage of the down payment assistance, and everything else is yours. You do have to be careful if people talk about really short-term loans. Like, I was talking to a realtor the other day, and she's like, yeah, I'm trying to get these buyers that, like, they wanna buy, and they were ready to go, and then now he found out that he may be relocated to a different state in a year, but I still think they're losing money by renting. And I was like, well, you have to be careful, because like they gotta pay it's gotta appreciate 6% just to pay the realtors to sell it, right? So 6% appreciation in the next 12 months with everything that's going on, I don't know. I don't think that's not the point that I would take with them. You know, you could show them how much they're gonna pay in rent and how much they would pay down the loan, but at the end of the day, 6% is 6%, right? You don't want them feeling like you pushed them into a situation where they're gonna lose money. And 1 year, I think, is too short of a time horizon, I think.
One thing I like to point out now too, it's not like a direct correlation to equity, and like, if you're staying flat on appreciation for a while, you know, you can't really make that sound glamorous. But one thing that you can make sound glamorous is the fact that your payment will stay fixed when you buy, when you own. So that's something that I'm leaning on a lot right now, is that, you know, with rent, your increases are unknown, and likely they're gonna be significant, more significant than your taxes and your insurance going up every year.
Yeah, and if values don't go up a lot, your taxes and insurance won't go up a
Yeah.
lot. So it becomes easier than the last couple of years when people call and they're like,
Yeah,
what's my payment going up $300? Like,
Yeah.
well, because
So
you
even-
gained $200,000 in equity, so.
Yeah, so even if they don't have like the guarantee or the comfort of high appreciation, they have security in the fact that their payment is basically fixed.
Yes, that's a great point.
And there is a housing shortage in Denver, there still is a housing
Right.
shortage in
Yeah.
Denver. So as people buy less houses, they're renting more, and as people rent more, the rents will go up,
Yeah.
regardless of what the market is doing, regardless of inflation or anything else.
Yeah, if rates, supply and demand, right? It always goes back to that. If rates move higher, or, you know, when we go into a recession, sometimes, you know, lending guidelines can change. It can become harder to qualify for loans. Then the buyer pool will shrink, and those people have to rent. And so the landlord's like, perfect.
Right.
And company, I was in property management before I did this. I mean, we were doing at some points like double digit increases, 10%, 12%,
Yeah.
15 plus. So it's hundreds of dollars you're talking about year over year.
Show
Right.
them on rent
There's-
versus own on the TCA, go out just 2 or 3 years. I mean, the number you pay in rent, it's money thrown out of the window is.
100% interest
Yeah.
rate.
Right.
Exactly.
Exactly.
Yeah, that's a great quote too. Yeah. What else? That's kind of what I had. Hey, almost an hour. So, not bad for starting at 4 a.m. this morning. Anything else?
Well, with inflation spiking,
Yeah.
right, so quickly, what's the expectation with the recession? Like, will it come down as fast, or will it take a lot longer?
I
Story.
think, you know, if listening to like Barry and stuff, cause the way they look at those like inflation reports are like over the previous 12 months. So if we go back, so they said basically, once we get to the October report, things should start looking a whole lot better. But that's not gonna be till November, so.
Right.
The reason why, let's see, do I have an inflation? Yeah, so, I mean, if you look at this kind of historical chart, as inflation, you know, starts to come down, mortgage rates come down right away. There's a little lag here. But in general, that report, basically, they're looking at, I don't remember what the number was like a year ago, but you know, the inflation was very low until like the fall, and then it really sped up quickly. So it was low numbers. So now, because there are still relatively high numbers now, it looks like a pretty big increase over the last 12 months. But once you get to October, I think it was like 0.8% increase in 1 month. That was like big red lights flashing. And now, by the time we get to October, if they do another rate hike next week, you know, it could easily be 0 or 0.1 or negative 0.1, something like that, maybe negative 0.2. So that could be a whole 1% lower than a year ago. And that will catch the attention, I think, of the bond market.
And to kind of change the conversation on why there is inflation right now, or point out, the Fed's printed $5 trillion in money in the past 2 years. There were $5 trillion in stimulus packages passed in 2 years, which is, there's not usually 500 million, you know, like, that doesn't happen. And this money's going to all these municipalities, and they're using it to do things, build a road, you know, good things, right? But these municipalities also have to borrow money just like me and you and our borrowers do, right? So when we're talking about the bond market, mortgage-backed securities is part of the bond market, but the bond market is any large institution, essentially. It's GE, it's Tesla, it's also the city of Denver and the state of Colorado borrowing money. So they're going out and they're like, okay, we have $20 million in stimulus money, but we have to spend $100 million on this road because that's the way the money came to us. So they're going out and borrowing $80 million. When they put that money out, they're paying a higher rate, just like we all are. So that project now can only cost 65 million in real dollars. They can only pay that contractor that much money. And so this has to cycle through, because before, when they're borrowing money at 2%, they could have paid that contractor $78 million. Now they're borrowing money at a higher rate, so they can only finish that project for less money. That has to cycle through where these contractors and everyone else is okay with taking less money, and that's what's gonna cause deflation, right? That's because they're doing the same job for less money. And then that's gonna trickle back down. So like, that's a big part of why raising rates is going to stop inflation, because the value of your money is going down very quickly now.
My coffee gonna get cheaper again?
Your coffee? There's a whole argument that I read on some blog or podcast or something, that inflation is actually like really good for like someone who's buying a house, right? Cause like, let's say you're buying a house and you're borrowing $500,000. Well, like, the more inflation there is, the less that $500,000 is worth, right? Like in the 80s, maybe you borrowed $100,000, and then there's a big inflation period, and then people were borrowing $200,000. So like, the person who borrowed 100, like, they're making more money now, and they're like, I barely owe anything on this house. Like, 100 is nothing anymore, right? Because the average person is borrowing 200. So it kind of makes your mortgage cheaper to do a reel about that, where the bank owes the debt, right? Which is gonna be worth less, really,
you
as
own
the
the
more
asset.
inflation. You own the asset. That's appreciated.
That's a good one.
Thanks, appreciate
Yeah.
it, yeah. Didn't come up with it, but I did.
Yeah, so that's side note, but what else?
Yeah, all these bonds, all these mortgage-backed securities, all these bonds that we printed in the past 2 years at 2.5%, 3%. That's the other part of it, is like, these people, me, all of us, right?
Yeah.
Most of us, we're not gonna sell our house and buy another house. You're not gonna lose your 2.75% interest rate unless there's a really compelling reason to do it. So, but some investor has a package of mortgages that's only paying them 2.5%. So that's why the difference in like what the indexes, like the what is it? Sorry, it's been a long morning. The Fed rate and the average rates that are being loaned is our rates are so much different right now because the runoff is different. Because at 3, they know that the runoff is not gonna happen. They know that they're at least gonna have that stable income. At 6, they're worried about that runoff being really quick, and they're not gonna pay us as much money, so we have to charge a different spread.
Yeah.
You know, so as the rates go up, and until the market decides where the rates are gonna be, we're gonna see a bigger spread between what the real rates are and what we have to charge, because we have to all make money. So
Do you know
that's
what he
why
means
that,
by
like,
runoff? Like how
fast
that
the mortgages
means
pay
for-
back.
Yeah, how fast it's paid off, right? So like exactly what we're telling people, you're only gonna keep this loan for like
Right.
6 months, I'm gonna
Right.
refund you in 2. Well, the banks, like, they know
They
that
know
that's
that.
gonna happen,
Right.
right? So they're like, well, we're not gonna pay you 2 points.
And between
or
us
whatever,
and.
At 6%, we're gonna pay you 1, we're gonna make the buyer pony up some cash so they have some skin in the game.
And we loan you know, we loan money, we're paying you, we're paying our rent, Wells Fargo is paying their rent, we're selling the loan to them, and then they're selling this mortgage-backed security, so that they know that that runoff is faster, so that difference in how much they're selling the loan for has to be bigger, because they have to still make the same amount of money in the same amount of time. So instead of making that interest for 6 or 7 or 8 years, statistically, they need to make all their profit in the first 2 or 3 years because they think this is all gonna run off. If the market all decides that this is where we're at, rates are gonna be 5.5 for the next 10 years, that spread is gonna be a lot tighter.
And that would be totally fine.
My spread
Yeah,
would
it's
be
fine.
If that happened. And-
Once the market doesn't care about rates unless they're changing. When everybody's like, yeah, it's 5.5, everybody's like, okay, fine.
Yeah, like, again, 2021 was so boring. It's like, yeah,
Right.
it's still 3%, still 3% 2 months later. I know you're on your 18th offer, it's still 3%. So, yeah, that's a good point.
Yeah.
One last question. So what if you have someone who you owe like an updated, owe them an updated rate check, right? Like,
Mhm.
it's like the weekend, they're gonna go shopping and you go in there and it's like, there's nothing at par. Like, it's like, you have to pay like $5,000 like to get a rate at all right now.
Mhm.
Like, what do you do? 'Cause
Show them that.
Show 'em.
just show them that.
Well, what else are you gonna do?
It's wild.
Tell them to get a seller concession to cover it.
Like there isn't
Yeah.
even,
You also-
there's no rates out there over 7% right now, so people that are buying investment properties, like they gotta pay like 2 points.
Oh,
With
at least.
25% down,
At
Right.
you know,
least.
4.5
Yeah.
points
And
with, you know.
usually what I've found too is that like
15%,
if they're having to pay points, like when you first quote them and rates go up, it's usually the same amount of points, just a higher rate, right? Like usually you're not gonna find a rate at par and then rates go up 0.5% and now it's the same rate but $5,000, right? Like usually you're always paying a little bit from the start.
In the very short term, you'll see that,
Yeah.
because they won't start printing those higher coupons until they know the rates are gonna be there.
They're gonna be like.
So in that
stable
short
at that
term,
range.
you will have that, I can't give you a higher rate, you have to pay for it until they start printing those higher rate coupons. So there'll be a very short term in that, but right now you probably should just start out, cause
With a point.
we all know these things, we all know things cause we look at it every day and do it every day. Customers don't. So if you start off the conversation with like, there's about 3/4 or 1% cost to get this loan, they don't really know the difference. They don't know that at some point you wouldn't have had to pay that, right?
Yeah,
You know, so,
that's right. I think I talked about it a few times, but on the TCA, you know, I always used to show no points, 1 point,
Mhm.
whatever, make a decision. Now I show them advertised rate with 1 point. And if there's no options with less, I don't show them any options with less. I might show them 2 points,
yeah.
you know, and
So you're not showing anything at par?
if there isn't anything.
Yeah.
Mostly not getting it anymore.
Yeah,
Yeah.
if there isn't anything, I mean, you can, so, and then I never get into like, by the way, I always recommend no points. I'm not having that conversation, cause I can't even do that right now, so it's like, hey, this is how banks are quoting rates right now.
I mean, until 2012, 14, something like that, you would never discuss a loan without 1 point. It was a 1 point origination is how you do it, start every
Just for the
conversation.
cost, not for, like, just for, not to buy down,
Just,
just
we
literally.
would just call it origination point. It was
Yeah,
just
really, yeah.
1 point origination, every conversation started that way,
Yep.
and then that might go up. And then the rate changed, but the cost didn't. Now,
So-
the way that we price things at, you might change the rate, you know, but
I might show them advertised rate 1 point, lowest rate, next
Mhm.
column 2 points. and then show them a third column that's like, hey, by the way, you can negotiate a $10,000 seller credit with no problems in this market, right off the bat, and now you can drop your cash to close by 10,000. We're like, oh, cool, so I get the lower rate on that, okay, let's do that.
100%. Yeah, great way to explain it.
A face-to-face meeting, so.
Nice.
Head to that. Thank
Yeah,
you guys,
man.
thank you Giuseppe.
Sure.
See you guys.
It was fun.
So Gio, what do you think's gonna happen next week when the Fed meets? I mean, obviously, the market expects another 3 quarters. I was talking to Casey yesterday, and he said if they raise it like 100 bips, that it could honestly make mortgage rates go down.
Yeah. Yeah.
Cause the market will go haywire, right?
Yeah, so I don't wanna worry about trying to log on to Gary Habib's thing anymore, but we can go to my office if you want and look at it there.
We can switch there.
Because I think that, you know, again, think of the bond market, right? They're concerned about inflation. So they know the Fed is like fighting hard to bring down inflation, which would mean a 1 point raise instead of the expected. 3 quarters doesn't seem to be working the last couple times. So it's gonna create more pain for the consumer out there, but it's gonna bring down inflation, so they could actually, if we look at, on that chart, I think June 16th was like the first
The meeting
75 basis
also.
point hike.
Yeah.
So yeah,
COC.
right, so June 15th was like when rates peaked until recently.
Right.
And like, that's the day